Hey guys, welcome to The Market is Open. We're going to talk about banks today. We're going to go through a whole bunch of different banks and look at how they've been performing or how they're going to perform during this crisis that we're seeing right now, and where all the banks stand relative to each other.
Yeah, so what's interesting is if we look at a JP Morgan, like JP Morgan in Q4 had a presentation showing that banks have had basically the most stable earnings growth, which typically investors like since 2010, and they have the lowest PE ratio out of all of the sectors. And during this recent market crash, I mean, oil's dropped, I think, the most, like 40%, but banks are, just a little bit behind them at, 39, 38%. And banks really have no underlying risk. There's no existential threat to for the oil market has existential threats to it. It might not even exist in a year from now, let alone in 10 years from now when electric takes a portion of the demand, or could take a proportion of the demand. But banks have, really gotten crushed, even the top tier banks. So we wanted to look at 6 of the banks. And the first one we want to look at is JP Morgan and how have they fared. So one thing on JP Morgan is, it's the biggest bank in the world, over $3 trillion of assets. Last year it earned $36.4 billion. So before this crisis, it was one of the biggest market value companies in the world. And the current price is $90, down from $140 just a few months ago. So, and they're trading at only 8 times earnings right now. So the bank, JP Morgan, looking at all their numbers is very attractive. So in their first quarter, JP Morgan was profitable, the quarter that just came out, and the company took $8.3 billion of provisions. So provisions is what you estimate will be loan losses going forward. So JP Morgan was very aggressive, taking $8.3 billion of loan losses. And one of the reasons is they have 18% of their loans in credit card, which is higher than most banks, but it's not that much higher. And they have about 6.4% in auto, which is around the same. So JP Morgan, they've been very prudent. They've been very aggressive. They have a lot of diversified revenue streams. And I calculated in my models that JP Morgan would be profitable under basically a variety of scenarios. So we put what would happen if they built their allowance to 4 times what it was in 2019. We found that JP Morgan would be slightly profitable this year. So we estimate the value should be about $131, even if, they had to build their allowance by 4 times this year. And I mean, I guess, Andrew, if you have any questions, what was in the model sort of thing looking at JP Morgan, but we could see the expected value here I got was $131. So I basically used a very simple model where we took the price before this collapse, and then I minus out what the company would lose this year relative to what it was supposed to earn before the crisis started. So, and then I netted the 2 numbers. So that's how I get, if JP Morgan was going to earn about $11 this year and now I expect them to earn 1, then I would say their value should only be $131 right now, because I expect them to only lose about around 1 year's worth of earnings from this.
Yeah, and I like how you separated out the credit card and auto accounts here. So like, are those things that, people could default on them a little bit more often than other categories because of what's happening right now? And is that like a risk to JP
Yeah,
Morgan?
so it's something more to consider when you look at the provisions. So JP Morgan took $8.3 billion of provisions, and you would expect JP Morgan to take higher provisions when they have a higher proportion of their money in credit cards. So it's something to note. So like when a company takes, let's say, less provisions, but they have less money in credit cards, then you sort of have to equalize a loan mix. So if you have 100% of your money in credit cards, then you should take a larger provision, all things being equal, than a company that has 0% sort of thing. So I just wanted to highlight it. So when we go across provisions by each company, that you sort of understand that, hey, JP Morgan has more in credit cards, hence they should probably take a bit higher provision than the next bank that we're going to look at. But do you have any questions about sort of the model and the allowance? So what I also assumed in the model is I assumed a 10% revenue drop for the bank across the board for the year. And I based it on PNC Financial said their revenue would be down 10% across the whole business for the year. They're basically the only bank that provided sort of guidance. So I based that to say if JP Morgan's revenue completely declines, which includes, fees on loans and revenue outside of loans. And then I assumed expenses stayed the same, which is actually strict, which is probably not a right ratio because PNC actually had assumed expenses would decline, but I just kept them the same that they would be. And then I assumed the allowance grew at 4 times what it was at the end of 2019. So that's how I got the valuation of JP Morgan. And I tried to use a consistent methodology for all the banks, except one, Capital One. I used a little difference, and we'll get into that in a second.
Okay, so let's go to the next bank to see how they compare.
So the next bank is Bank of America, second largest bank in the U.S. So if we look at them side by side to JP Morgan, them and JP Morgan have really turned it around, but Bank of America earned $27.4 billion last year. They're trading at $22. Their valuation is only $197 billion. Based on their PE last year, it's only 7.5 right now. So when we look at Bank of America, they took provisions of $4.8 billion in the most recent quarter. So again, I like to compare it of what they were doing before. So this is 5.6 times. I showed it was 5.69 times what they were taking on average over the last 3 years. So you can see JP Morgan is being a little stricter, taking 6.32 times. And Bank of America only has about 10% in credit card, 5% in auto. So you would expect them to take, a bit slightly less provisions. JP Morgan, though, was extremely aggressive on how much credit card provision. They took basically 10% of their loans. They put an allowance against, which is a huge provision. It's even higher than, it's basically higher than the worst credit card issuers. So it was aggressive. Their deposit growth at JP Morgan was 18%. So like JP Morgan grew deposits by $300 billion. Bank of America grew it by 10%, which is insane. You could just see like the crazy inflation that could be created from this event. But for now, it's just the big banks are just, JP Morgan, like I read an article, they basically like devoured an entire, like the fifth biggest bank. They like 300 billion of deposits were added into them just in one quarter alone. It's insane. Yeah. And so I looked at Bank of America, their allowance, if they built it by 4 times. So I just kind of used an arbitrary 4 times ending allowance. I assumed this would actually be somewhat consistent across banks. So Bank of America would have to recognize about $5.6 billion of charges a year. And basically from this, I got that Bank of America would basically break even this year if the worst case scenario happens. So their valuation should only be down by about $3, but they've dropped, it's $22. So Bank of America, like JP Morgan, looks like a pretty good buy, but I think JP Morgan's an even better buy just because it seemed even more undervalued before this crisis, just given its operating leverage. But Bank of America seems quite interesting at these prices. And we sort of look at what added risks there are. So I don't know. I haven't gone through so in depth on BAC. I've gone a bit more on JP Morgan, but I don't see any extra special risks that BAC has more than I could think about. You'll see why I added that category for the next bank.
Okay, and JP Morgan is like they're like a very well-run company, I think, right? I think historically they've actually done quite well even during bad times, whereas Bank of America, I mean, at least historically, has been a little bit more hit and miss.
Yeah, sure. And definitely since Jamie Dimon took over JP Morgan, they've been earning better results than the rest of the bank. But no, I think Bank of America and JP Morgan are both super well run right now. So I want to go to the next one. And historically, Wells Fargo has been one of the best run banks. But right now, they've been going through some difficult times. So a couple things I wanted to highlight was one, just Wells Fargo has more of these. They have $14.3 billion in loans in oil and gas, $27.8 billion in retail. So it's a bit of a cause for concern. So that's one negative. Their oil and gas loans is about the same percent as JP Morgan, but they definitely have a higher percent in these retail areas than JP Morgan and Bank of America. So that's a bit of a negative, but on the positive side, they only have 4.3% of their loans in credit card right now and only 1.5. Sorry, not 1.5. They have about 5% of their loans in auto, which is about similar to the other banks. So if you're looking at this, it's like Wells Fargo should have slightly lower provisions considering, credit cards always have higher provisions. So last quarter, Wells Fargo took about $4 billion in loan losses, and it compares similar to Bank of America, even though they have a lot less in credit card loans. But it's about the same. So Wells Fargo's provision seemed, mostly appropriate last quarter. They earned only $19.5 billion. So Wells Fargo was, the biggest U.S. bank for a long time. Market value is only $111 billion now. Based on their PE last year, they're only at 6.65. So it's pretty cheap PE. But there are reasons why you should be a little worried. So one, the U.S. government has had a restriction on the size of Wells Fargo's growth, and that's really hampered the company's ability to operate. And they can't even actually grow deposits right now because they can't go above this asset cap. So they might actually have to sell assets if they get too big, which could mean recognizing losses earlier than you think. So it's just like an extra risk. So one thing, I expected Wells Fargo to lose about $4 this year if, the worst case scenario happens, plus they would lose their $4 in earnings. So I said their price, the expected value would be about maybe $38. But I also said that it's kind of even riskier to hold Wells Fargo because the company is sort of going through bad times right now. They're in the middle of a turnaround. This is sort of the worst time for it to hit the business, that you would want to own a company that was sort of, they sort of needed a turnaround this year and they were not going to be that profitable this year. And now they're being hit by, loan losses and something. So I wouldn't be, jumping to buy Wells Fargo right now, even though it's down like 50% this year.
And did they have this problem with the credit card scandal where they were issuing credit cards like crazy? Does that affect that affect the company right now? And because isn't Warren Buffett also selling as well as Fargo, or he's trimming it?
Yeah, it looks like Buffett was selling out of Wells Fargo. I'm not sure if he'd be selling out right now just because the stock has gone. Like he was selling out at the beginning of the year because you could sort of see at the end of Q4 that Wells Fargo was going to have a very difficult year this year, and the stock was still trading at, a bit of a premium valuation at the start of the year. But right now it's trading, at a low valuation. I said 6.65 times last 12 months earnings, but really not that much below JPM and BAC considering the risk that, if we have a severe downturn, would you want to own a bank that earned $36 billion last year, or a bank, Wells Fargo, in their last quarter broke even? Like in Q1, Wells Fargo broke even with a $4 billion provision. JP Morgan made like $3 billion with an $8 billion provision. So
yeah, that's a good quarter.
And Wells Fargo, the quarter before that, only earned $3 billion. So do you really want to own a company that, is not, like, their new CEO called the company inefficient or something like that? Like it's not the best time to own Wells Fargo, though. Like their valuation has dropped a little more than the other banks, but I don't know if it's dropped enough in comparison to really rationalize buying a bank that's going through operational issues when there's risk right now. Okay, so we've gone through Wells Fargo, Bank of America, JP Morgan. Now let's go over U.S. Bank. Okay, so we got U.S. Bank. They tell us a breakdown of their loans. They show 0.6% in airlines, so they don't have a big amount in energy. Like everything seems fine in terms of their loan. Nothing extra special for them. So they earned about $7 billion last year. Their market value right now is $51 billion. Last 12 month earnings is about 8 times. So everything looks good. Their credit card's only 7.5%, and their auto loans is about 6%. But one thing to notice is the last quarter they only took provisions of $993 million compared to their average quarterly of $356, which is only at 2.52 times. This is much lower than all the other banks, which sort of makes me worry that in future quarters, a lot of banks have sort of already over-reserved or gotten ready for the worst, but U.S. Bank is not really doing that. So it's more likely they would lose money in future quarters. But a lot of deposits did flow into the bank. I did the same sort of scenario where, U.S. Bank loses 10% of revenue, and I said they would lose 241 this year. So based on, where it was before the incident, I said that their value could be between 45 to 49. And one thing that I handicapped of U.S. Bank is I'm not sure how many banks are in it's sort of called a merchant acquirer, but U.S. Bank would be responsible for refunding airline tickets. So apparently you could be an acquirer of airline tickets, which means you have the financial risk if customers want refunds. So U.S. Bancorp could potentially be on the hook in the worst case scenario of $8 billion in airline refund tickets, which I don't think it would be all of the airlines defaulting, but there's some sort of risk, and U.S. Bancorp built a $100 million reserve. And I do have a website that I will just post up quickly here showing that, U.S. Bancorp has staffed their call volumes with 4 times the amount for these sort of returns. And a lot of airlines are saying, hey, we're not going to return your refund. So that could put U.S. Bancorp on the hook for some of that. So that's a bit extra risk that U.S. Bancorp has. But at the same time, that would, even if like U.S. Bancorp has 1,500 shares or 1.5 billion shares. So even if 1/8 were returned, that would only be less than $1 a share in earnings. So it's not a huge risk. Okay, so let's do PNC. PNC is also one of the largest banks. So PNC earned $5.4 billion or 11 times last year. They're trading at under 9 times earnings. Their provisions, they took $914 million in their latest quarter, and their average quarterly provisions are 1. So they took 8.5 times, which is incredible, the highest out of all the banks. Credit card is only 2.7%. And auto is 6.5%, which is comparable. They had pretty nice deposit growth too. So I said under the crazy scenario, PNC would build $8.2 billion and they'd lose $4 a share, which I think is a little high given how, good their loan quality is and how little credit card is. But, it's sort of just an arbitrary metric that I took. So I said, even with all this, given that they traded at 160 before this crash, they would lose 1139 this year plus an extra $4 loss. That would bring their valuation to 146, which is about 45% upside from the current price. And PNC just has a better loan portfolio than their peers. So they were taking only 100 million of provisions before this crisis, and now they're much, much lower than all the other banks. So PNC has a better loan portfolio that could more likely survive in a severe recession. So PNC would be another bank that I'm quite comfortable, and I could say I own it, and JP Morgan. Should we go to the last bank?
It's got some big upside too. I see you have the upside numbers over here, and I think JP Morgan and PNC are, I guess, some of the highest.
Yeah. So, but what I like about JP Morgan and PNC is they have like the most upside, Bank of America too, but not a lot of downside. Like US, Bancorp, and Wells Fargo have a bit of hidden downside, like especially if this crisis lasts a bit longer. They have a bit of downside, especially if this crisis lasts a little longer. And Capital One Financial, let's go over there. The last bank, so they earned $12 a share last year. They're trading at $56 right now, so that's a PE of less than 5 times. They took $5 billion of provisions last quarter, which was only about 3.31 times their average provisions. Credit card is 45% of loans. Auto is 23%. Deposit growth was only 2.7%. So Capital One doesn't have that nice deposit base that JP Morgan has, where they can raise funds very cheaply, but they still, have a big deposit network, unlike crappier credit card companies like Discover or Synchrony. So I said that over a crazy, if they build allowance by 4 times, they would have to build about $4.3 billion after tax a quarter. I said that means they would lose about $15.20 this year, plus the $12 that they didn't earn. So that would knock their valuation down from 100 to 73. However, one thing that helps Capital One is the fact their valuation was extremely low before this crisis. They're trading at less than 8 times earnings before this crisis, when all the other banks were trading at like 12 times. So that's something to note. Even Capital One was even trading cheaper than credit card issuers. So that's a bit of an upside that I think Capital One was really undervalued before this crisis. But given where we are in the crisis, you would expect it to be at $73, which is about 30% upside from the current price. I still like Capital One, but it definitely is, if this crisis lasts a couple of years, Capital One may have to, rebuild a bit more capital than the other banks who are more diversified businesses. This sort of crisis is hitting, credit card and auto hard. And 2008, Capital One actually barely had any losses. I think this is sort of a unique event that's hurting, especially auto right now. But credit card so far looks like it's faring up a little better, but it just seems like, a very unique event that's hitting credit card companies a little harder.
That's all. Okay.
That's it. Yeah.
Do we have a summary, you think? No.
Yeah. I mean, a summary, just a quick summary to finish it. If I had to choose, I would pick PNC 1, JP Morgan 2, BAC number 3, Capital One, Capital One and US Bancorp basically tied at 4, probably US Bancorp 4, Capital One 5, Wells Fargo 6, just because I wouldn't really want to own a bank in the middle of a turnaround right now as Wells Fargo.
Awesome. All right, guys. Well, thanks so much for watching, and please hit the subscribe button and the like button to support this video.